If you're looking for ways to get more money into Roth tax advantage savings accounts, then this video is for you. Welcome back. This is episode 210. In this week's episode, I'm going to address a question that I get often from clients and listeners, and that is, how do I get more money into Roth accounts? And more specifically, for people that earn too much to contribute to a Roth IRA in the traditional manner, I'm going to discuss 4 ways that you can get money into Roth advantaged accounts. And as a reminder, last month I published my first book. It's called Fiduciary: How to Find, Hire, and Establish an Aligned and Trusted Partnership with a Fee-Only Financial Advisor. If you haven't checked it out, you can learn more by going to retirewithryan.com and clicking on book. And if you have purchased a copy and read the book, I would greatly appreciate you leaving me a review on Amazon if you haven't done so already. So let's talk first about the traditional Roth IRA contribution, how you do that and how it works, and then we'll talk about the 4 additional ways that you can contribute to money to a Roth IRA account. So a Roth IRA is after-tax contributions. So why would you want to make a Roth contribution or get money into a Roth account if you believe that tax rates will be higher in the future, or your tax rates will be higher in the future, the taxes that you pay on your personal income? It could be very beneficial to have money in Roth accounts, because with Roth accounts, the contributions you make are not tax deductible, but they grow tax deferred, and when you take them out, they are tax free. So having that tax-free income, especially if our tax rates in the U.S. go higher, can be very beneficial. So this year you can contribute $7,000 to a Roth IRA if you make the full contribution, and then if you're over 50, there's an additional $1,000 catch-up. However, there are modified adjusted gross income limits that your income has to be under for you to make these contributions. So let's cover what those are. So if you're a single filer and your modified adjusted gross income is under $146,000, then you can make the full Roth IRA contribution. Once it goes over $146,000, your income, or your contribution, I should say, starts getting proportionally reduced to where your income is then over $161,000. You can no longer contribute to a traditional IRA for a Roth IRA for 2024. Let's talk about if you're married filing jointly. So that has a higher modified adjusted gross income limit. It's $230,000 for 2024. So if your modified adjusted gross income is under $230,000, you can make the full contribution. Once it goes over $230,000, it starts getting proportionally reduced, the contribution that is, to where if it's over $240,000, then you can no longer make a Roth IRA contribution. So prior to 2010, if you fell into one of these 2 situations, now granted, these modified adjusted gross income limits have consistently been raised every year, and they are raised every year by the IRS, but they're not raised a significant amount where they're going to double the modified adjusted gross income limit. But prior to 2010, if you were over this modified adjusted gross income limit, you couldn't contribute to a Roth IRA. There was none of these other methods that we're going to talk about really weren't allowed or even in existence. So the good news is that thanks to the 2017 tax cut, there's a few additional ways that you can contribute now to a Roth IRA. So let's talk about the first one. I've talked about this in past episodes, and this is known as a backdoor Roth IRA. So what does that mean? That means that you're contributing to a Roth IRA, but not directly. You have to do it in a backdoor fashion. And I talked more about this in episode 176. So if you go to retirewithryan.com/podcast/176, you can listen to this in greater detail. But with the backdoor Roth IRA, you have to set up both a traditional IRA and a Roth IRA with the same investment company. So as I've mentioned, my company uses Charles Schwab to hold its clients' money. You would set up a traditional IRA and a Roth IRA with Charles Schwab. You make a contribution to a traditional IRA, but you do it as a non-deductible contribution. So let's say you put in the $7,000, then shortly after you fill out a request with Charles Schwab to convert that money over to the Roth IRA. They move it from the traditional over to the Roth, and now it's into the Roth. And it's relatively straightforward and simple. However, there are a number of mistakes that you can make with this, and I have an episode on that too. But one of the biggest mistakes I'll just let you know about is having SEP, simple, or traditional IRA assets in your name during that tax year that you're making the contribution. So let's just say, for example, you wanted to take advantage of this and you have an IRA from an old job with worth $93,000. And you want to put the $7,000 into the Roth IRA, the backdoor Roth IRA for this year. So what you'd have to do is a quick calculation to figure out how much of the conversion would be tax-free. So you'd add up the amount you were converting plus any existing IRAs in your name. So we take $93,000 because you have a traditional IRA plus the $7,000 contribution, and that gives us $100,000. You would then divide the amount you're converting, which is a $7,000 divided by $100,000, and that gives you 7%. So of that $7,000 you're converting, only 7% of that is tax-free. So the other 93% of the $7,000 you'd have to pay tax on again. So think about it. You already paid tax on that money because you're making a Roth contribution. You paid tax on that $7,000. Now you're going to pay tax on that $7,000 again when you do a conversion. So this is why it doesn't make a lot of sense for people to do a backdoor Roth IRA contribution if they have money in a SEP, simple, or traditional IRA, rollover IRA. So what can you do with that money? How can you get around this? Well, if you have a 401k through the company that you work for, if they allow rollovers, you could roll over that money in the traditional IRA into the 401k. And as long as you do that by the end of the tax year that you're doing this conversion or backdoor Roth contribution, then that money will not be counted in the calculation. So in that case, because you had no other IRA assets, let's say you did this, you got this money rolled over to your 401k, that $7,000 would not be taxable. So that's why the backdoor Roth IRA can be so beneficial, but you can't have a SEP with money in it, a simple IRA with money in it, or a traditional IRA with money in it in the year that you're doing the conversion. So the traditional IRA is pretty easy because there's no reason to keep that account if you don't want to. If your 401k allows it and you have good investment choices in your 401k, low cost options, then consider rolling that over. But let's say you're at a company that offers a simple IRA and you participate in it. Well, it's kind of hard for you to close that account and roll that money over. So that could be limiting to the backdoor Roth IRA contribution, or if the company has a SEP IRA they contribute to on your behalf, that could also be limiting. But if you're self-employed and you had set up a SEP or a simple because they are relatively easy to administer, consider setting up a self-employed 401k or a solo 401k. You could do that with Charles Schwab, Fidelity, a number of companies offer these, and you could then move the money you have in the traditional IRA or the SEP or the simple over into the 401k, and that could allow you to take advantage of this as well. The next way to get money into a Roth account is through your 401k plan. If you're an employer or you're self-employed and you elect the option to have a Roth 401k, that's a way that you can get money into the Roth because there are no MAGI income limits on how much, or who I should say, can contribute to a Roth 401k. So you could make well over the traditional or the Roth 401k MAGI limits and make a contribution into a Roth 401k. So the same limits that apply to the 401k apply to the Roth. So it's $23,000 for 2024. And if you're over 50, you can contribute an additional $7,500. This is called a catch-up contribution. So you can split your money between the traditional and the Roth any way that you see fit. You could put it all into the Roth. You could put the whole $23,000 into the Roth if you wanted. Or you can split it up. Maybe you could put $10,000 into the Roth and $13,000 into the traditional. It's really up to you. But if you want to get money into a Roth account and your MAGI is too high to do the traditional, Roth 401k contribution, and you don't qualify for the backdoor Roth IRA or you don't want to go through that, then think about the Roth 401k. The next option is doing what's known as a Roth conversion. So currently, anyone can convert money that's either in a traditional IRA or a traditional 401k over to a Roth IRA or Roth 401k. And what you'd be doing is you'd be paying taxes now on the amount that you're converting based off your current tax rate. So let's just say you had $100,000 in a IRA that you want to move over to a Roth IRA. Then you could convert that $100,000, pay tax on the $100,000. So you'd add that $100,000 you're converting plus any other earned income for the year. So if you already worked the year and got a W-2, you add that plus your $100,000, and you'd pay federal and state tax if you live in a state that has state income tax on this conversion. So why could this make sense? Well, one reason is that you don't have to pay the 10% penalty on the conversion. So normally if you take money out of a 401k or Roth IRA prior to 59.5, there's a 10% penalty. But in this case, there is no 10% penalty prior to doing this conversion prior to age 59.5. The other thing is that if you think you're going to be in a higher tax bracket in retirement and you have a long window until you're going to need access to this money, let's say 10, 15 years or longer, then it could make sense to convert this money over to a Roth IRA or Roth 401k because it will have the benefit of growing in a tax-deferred manner and making back the money that you're going to have to pay in taxes up front. So traditional IRA to Roth IRA is one way to do this. Another way is that some 401k plans allow what's known as an in-plan conversion. So if you're still working and most of your money's in your 401k and you want to leave it there because you're already doing the backdoor Roth IRA, then possibly your 401k plan could allow an in-plan conversion. So the plan would have to offer a Roth 401k, and you could choose a certain amount that you want to convert from the traditional IRA over to the Roth 401k. And again, just like we talked about earlier, you'd pay taxes based off the amount you're converting, but it is a way that you could possibly move money from the traditional 401k over to the Roth 401k if your plan allows it. And according to Fidelity, about 40% of 401k plans offer this feature. But again, the things you have to consider are how much taxes are you going to owe on this, and is this conversion going to push you into a higher tax bracket? It's the same thing to think about if you're moving a traditional IRA over to a Roth IRA. And the best time to do any conversion, in my opinion, is either when your income is low. So if, let's say, you're going to be retiring soon, that could be a good time to do a Roth IRA or a Roth 401k conversion because your income will be lower, presumably, when you're retired, especially if you haven't started collecting Social Security yet. This could help you to have a lower income and can be a good time to do Roth conversions. Also be aware that anytime you do a Roth conversion, that is income. And if you're going to be going on Medicare soon, that could cause you to have to pay higher Medicare premiums. So you could be triggering what's known as an IRMA charge, which is an additional monthly amount that you and your spouse would have to pay for Medicare Part B premium or Part D prescription drug premiums. So you have to weigh that added potential costs that you could have. And the other thing is this could also trigger a 3.8% surcharge on net investment income. That's an additional tax when you have income over a certain limit. So definitely a lot of tax things to consider here when you're doing a Roth conversion that you want to talk to your financial advisor or even your accountant as well. And then also, if you're moving in retirement, let's say you're planning to move to another state, you might want to investigate how that state would tax this Roth conversion. Is it going to be taxable? Because if it isn't, then maybe you want to wait until you move to that state to do a Roth conversion. Or some states don't have income tax, which could be even more beneficial if you're moving to a state with no state income tax. That way you wouldn't have to pay tax on this conversion. So the last option we're going to cover, and that is called a mega backdoor Roth IRA. And this is a little complicated, but I covered this a while ago in episode 87. So if you want to listen to more about it, you can check out retirewithryan.com/podcast/87. So some 401k plans allow contributions above the traditional $23,500 limit. So the IRS has a total pension profit sharing contribution limit And for 2024, that number is $69,000. So this is the total that you and your employer can contribute to your retirement plan. So let's say, for example, that you're contributing the maximum to the traditional 401k of $23,500. And your employer matches into your 401k plan. And let's say that match adds up to $65,000. So for the year, between you and your employer, you will contribute $30,000. Well, because you have not hit the maximum of $69,000, there's an additional $39,000 that can be contributed into your 401k plan. And what that means is that that additional $39,000 could be contributed into your plan as an after-tax contribution. That's what the mega backdoor Roth IRA is. And if you're over 50, you could also contribute that additional $7,500 catch-up. So this is a tremendous additional amount that could be contributed to your 401k on an after-tax basis that allows you to put more money in a tax-deferred account to grow on a tax-deferred way. Keep in mind, however, government 457 plans and most 403b plans do not allow this after-tax contribution, but many 401k plans do. So you'd want to check with your 401k provider, first of all, to see if they allow after-tax contributions. And to really get the most out of this, what you would want to do is shortly after making this contribution, you would want to convert it either into the Roth 401k in your plan, if they have a Roth 401k, or convert it over to a Roth IRA, so that any gains you have on this after-tax contribution are going into the Roth side and are then growing on a tax-free basis. So that $39,000, let's say it doubles in the next 10 years. Well, if all that growth is tax-free, now you have doubled the amount you have on a tax-free basis that you can take out. Because if you don't convert it to a Roth IRA or Roth 401k, that after-tax growth is going into the pre-tax account. So it's going over into your traditional 401k, and it's growing on a pre-tax basis, and meaning that it will be taxable when you take it out. So that's not as beneficial to having it go over to the Roth side where it will be tax-free when you take it out. So again, you have to check with your company to find out, first of all, do they allow this? And then secondly, do they allow in-plan conversions to either move it over to the Roth 401k, or do they allow you to convert it out of the 401k over to a Roth IRA? So most plans allow this once you're 59 and a half, but not all of them allow it prior to 59 and a half. So some plans do. So if they do, that's very beneficial, because then after you're making this after-tax contribution once a year or every so often, you could pull out the money or convert it over into the 401k. That way you're getting it as quickly as possible into the Roth side, so that you're going to have even more tax-free money. So again, to learn more about this, check out episode 87. And according to a study that I read recently, about half of Fortune 500 companies offer this. So you have to check with your employer or whoever administers your 401k plan to see how they allow this and how you could set this up. So I've given you 5 ways to get more money into a Roth IRA. One of them is the traditional route, but the others are non-traditional. So make sure that you investigate this further. Either talk with your financial advisor or your accountant to figure out how you can get this done and get more money over to the Roth side so that you can benefit from that tax-free income in retirement. Because as it stands now, after 2025, some of these ways that you can contribute will most likely be eliminated unless Congress puts forth another tax plan extending the 2017 tax cuts that are set to expire. If you haven't checked out my book, please do so by heading over to retirewithryan.com. And as always, if you have a listener question you'd like to have considered for a future episode, you can also leave it by going to retirewithryan.com and clicking on Ask a Question. Have a great week, and I look forward to talking with you next Wednesday. Take care.